In this short film, we look at multi-asset investing with contributions from Trevor Greetham of Fidelity and Richard Roma-Lee of fund research organisation OBSR. So, what is multi-asset investing?
Well, multi-asset investing is where in a single fund you can get exposure to a range of different asset classes that tend to behave in different ways. So each of them has its own characteristics that make it worthwhile holding for the long run. But you may find there are times when one is doing much better than the other. And by investing in all of them, you're spreading your risks across different types of investments, and you're generally stabilizing returns. To give an illustration of when different asset classes do well, we use what we call an investment clock approach, which looks at the economic cycle. And if you think back over the last sort of 5 to 10 years, it's pretty clear that, for example, bonds do well when growth is weak and inflation is dropping. Stocks do well when growth starts to recover. When inflation picks up and you're in an overheating world economy, commodities are a useful arrow to have in your quiver. And then in periods of stagflation, where growth is slowing down, inflation's going up, central banks are not really on your side yet, interest rates are high, and cash is quite attractive. So you definitely have this sort of progression of different asset classes at different stages of the cycle, which is why investing in all of them makes sense.
Is multi-asset investing the same as fund of funds?
Not really, no. Multi-asset investing is a fund which invests in a range of different asset classes. You can achieve that by investing in other funds, so it could be a fund of funds approach. Alternatively, you can invest directly in the underlying asset classes. So it doesn't necessarily need to be a fund of funds. Although I would say some fund of funds could be termed multi-asset funds.
The traditional multi-asset fund is the so-called balanced fund. And a balanced fund would typically have equities and bonds. And the equities are in there because they give you a share in corporate profits over the long run. So they're a risky asset, but they offer you a better long-term return because you are taking some risk in an entrepreneurial kind of way. So stocks are a very important asset class to include in any long-term portfolio. Bonds are there because they tend to do well when growth is weaker. They tend to do well when inflation's falling. And they're a more steady asset class over the long run. They give you your capital back at the end of the period, assuming that the government or the company you're talking about still exists. And usually they do. We would include more asset classes than that, though. For example, commodities. I think 2008 was a great message that there are times when commodities are really the only thing that's doing well. So there are times when there's just too much growth in the world. It's forcing the oil price higher. It's forcing interest rates up. And commodities can make people good money at those stages. And we all know that the sort of China recovery story, the China development story, is not going away. We'd also include cash. It's often overlooked, but there are definitely times when cash is an asset. It's more about capital preservation than return, typically. So cash is the most stable, steady, guaranteed kind of asset. And then finally, we would include property. The property cycle tends to be different again. So altogether, I think that gives us 5 asset classes: stocks, bonds, commodities, cash, and property.
Diversification sounds good in theory, but does it work in practice? And what sort of a skill set does a fund group need to do it well?
Diversification across asset classes is working better than ever. So in the 1980s and the early 1990s, what you tended to find was bonds and stocks, in particular, moved in the same direction as each other. So they were both benefiting from this long disinflationary recovery that we all enjoyed from 1980 onwards. What's happened in the last 10 years is they've been moving in opposite directions. So you get an economic recovery, stocks go up, bonds are pretty so-so. You get an economic downturn, and suddenly you're finding yourself making good money on government bonds. And that's so-called negative correlation, where they're behaving in the opposite way to each other, means that you combine them together and you get a much smoother month-to-month risk-return trade-off, much less volatility. Commodities also have very low correlations with other asset classes. So I think diversification is an old idea. It's working really well, and it's well suited to an environment of short, boom-bust cycles, like the 1970s, for example. And I have a feeling that's the sort of environment we're now in, because we've had so much policy thrown at the problem at the moment. At some stage, the policymakers will overdo it. Later on, they'll have to slam the brakes on again. We can just imagine. So we're going to have an environment where assets will be going up and down on a regular basis, and diversifying across them makes a lot of sense.
What should you look for in a group that offers multi-asset investing?
There are a number of aspects to multi-asset investing which are important. That's from initially explaining what the offering is, what the objective is, what the risk profile is, and so on. And I think you need to look at a range of different layers. For example, if there is some asset allocation going on, either strategic or tactical or both, you need to understand how that works. You need to understand how that is formulated. You need to understand the experience of the people in that process. That might be the fund manager as a whole, it might be the economics input, it might be the risk input, it might be the input from the bottom up, so from within the particular asset classes themselves. Then you have to implement the asset allocation, so it's really important to make sure that the group is capable of equity stock selection or fixed income stock selection or property management or whatever it is. So they need to be capable of that, or selecting fund managers in the case of a fund of funds who are capable of delivering to objectives within an asset class.
What's the difference between strategic and tactical asset allocation?
The main difference is time. Strategic asset allocation represents a mix of assets which are appropriate for a client's risk profile and to try and achieve a specific return or risk profile over a period of time. So over the longer term, if you were a balanced investor, you might want a portion of your assets in equities, a portion in bonds, a portion in property. However, in the shorter term, there are tactical opportunities that might arise because of sharp moves in markets or sharp opportunities because of the economic or credit cycle, which enable you to move exposure actually within asset classes or at the margin between asset classes.
Given all of that, where does a multi-asset product fit into a client portfolio?
I think it varies. For some people, it's a one-stop shop. They're able to identify their objectives and risk profile, and a fund management company might be able to provide that in one fund. In a wider context, if people want diversification, actually multi-asset funds, depending on their objectives, can form part of a much bigger portfolio. For example, if they have an absolute return mentality or a target return, actually that might suit for a certain portion of somebody's investment portfolio.
Well, I think the sort of investor that would choose multi-asset investing is either somebody who is uncertain about the drivers of a particular asset class. So, for example, if people are nervous about the outlook for stocks, that they have this idea that they're good value but they're worried about the economy, these sorts of people could build up exposure to stocks in a multi-asset fund and know that if things go wrong, they've got government bonds in there as well as a stabiliser. Or it's people who have a different risk-return trade-off. They want to have a more steady sort of fund because maybe their investment time horizon is 5 years rather than 20 years.
That was the JCI Guide to Multi-Asset Investing, with contributions from Trevor Greetham of Fidelity and Richard Romer-Lee of OBSR.